Kanwal, thank you so much for being here. This was the one strategy that I think I personally enjoyed the most too, of all the different choices. And that's part of the reason why I want people to understand and to learn more about what we're talking about. I also wonder too, it's like, because I was a financial advisor, I know what this means, but people who aren't probably don't. And Jessica does not come from a financial background. And so, Jessica, you're going to help ask some really good questions here, because if we can keep it really basic, I actually wonder right now if people aren't here because they don't even know what it is. And we didn't give them enough of an introduction to what it is.
So thank you for having me here. I really appreciate it. I'm excited to get going. I've got a couple of slides. It's going to take about 30 minutes to go through all of the material, but I do want to share as much as I can with your community, and just, you know, I'm a big advocate of teaching, of education, and I think that's the biggest piece that's missing, right, is education. So once people understand how things work and how to invest in this way, then you'll be able to make better decisions. Title, I've got two titles here: How to Build a Growing Stream of Passive Income. And like Lisa was suggested before, we're going to focus on dividends, dividend stocks. Or in other words, how to build a resilient stock portfolio, regardless of what the economy is doing and what the stock market is doing. So, okay, so in this presentation, like I said, it's 30 minutes. You're going to learn how to make money by creating a new passive stream of income for yourself, and at the same time, minimize your risk. Okay, I want to get some of the three sort of basics out of the way first. And some of you may know this already, some of you may not. And we're recording this, so we'll have other audience members watch it later. I want to make sure we're all on the same page, right? So what is a stock or a share? So basically, a stock represents ownership in a company. So for example, Coca-Cola has a little over 4.2 billion shares outstanding. And if you were to buy all of them, you would own the entire company. It would be an expensive venture, but you could certainly do that. But even if you own one share, or 5 or 10 or 20 shares, you are technically part owner of the company. As an owner of the company, you're entitled to share in the profits of the company. And that brings us to the next question: what is a dividend? So a dividend is basically the company sharing its profits with you, the shareholder. So in this example, if a company is paying a dividend of $1 per share and you own 1,000 shares, you will receive $1,000 for as long as you own those shares and as long as the company continues to pay the dividend. And this is cash. It gets deposited into your trading account as cash. So you can spend the money if you want, or you can reinvest it. It's entirely up to you. And this is truly passive income. Like, you're not having to work 40 hours a week or X number of hours a week or take on a second job. The company will continue to pay you these dividends as long as you own the shares and as long as they continue to pay a dividend. And this is regardless of the share price, because once you've purchased the shares, in this case, 1,000 shares, the stock price can go up and down next week, next month, next year. It doesn't matter. But as long as the company is paying the dividend, you'll continue to receive, in this example, $1,000 every year. So what is a dividend yield? So the dividend yield is really simple. It's the dividend divided by the share price, or the purchase price. So in this example, let's just stick with the same example. Let's say the company is paying a dividend of $1 a share, and you were to buy the shares today, and the price happens to be $20 per share. Your dividend yield is going to be 5%. Okay, so what does that mean? What does 5% mean? So let's say in this example, you were to invest $5,000 into this company. So 5% of that is $250. So that means you will receive $250 in dividends, again, for as long as you own those shares and as long as the company continues to pay the dividend. So this could go on for 20, 30, 40, 50 years, right? As long as you continue to hold on to those shares, you'll receive, in this example, $250 each year in dividends. Another way to look at it is the same 5,000 invested in this company at $20 a piece, you'll be able to buy 250 shares. And so we take that and multiply it by the dividend per share, and we end up with the same number, $250. So basically the dividend yield is the return on your investment while you hold on to your shares, okay, regardless of the share price. Because again, if you've bought the shares at $20, that's fine. Doesn't matter what the share price is going to be tomorrow or next week. It could drop, it could go up, but you're still going to earn 5% on your investment while you hold on to those shares. So does that make sense so far?
Yes, it does. Question. So the return on your investment while you hold on to your shares, regardless of share price, is going to be 5%, but that can change when the share price changes because it's still 5% of the share price, right?
No, it's 5% of the purchase price. So your
It's
purchase
all
price
based on the
doesn't change.
purchase price.
That's correct. Yes.
Oh,
Yeah. So it'll be
wow.
5% forever as long as the company pays
So,
the $1 dividend.
so the dividend is based on the purchase price. So if the purchase, if the stock goes up by 100%, you're still getting paid the same dividend. It doesn't matter how much it's gone up.
Correct. The dividend is always paid per share. So it's in
Mhm.
this case, it's $1 per share. So if you own 10 shares, you'll get $10. If you own 100 shares, you'll get $100.
Got
The
it.
dividend yield is always based on the dividend divided by your purchase price.
Learn something new. That is really
Yeah.
funny. I had to pass all those tests. I'm not sure if I'm forgetting it or what, but I'm definitely having a breakthrough moment already.
Yes, I
Thank
mean,
you.
all things, yeah, you're welcome. All things considered equal, if a company has a dividend yield of 1% and another company has a dividend yield of 5%, all things considered equal, you're better off investing in the company that's paying you 5% yield. You're going to get more in dividends rather than the 1%. Yeah. Is there a
Right.
question?
Yeah. So does that mean that the dividend dollar, like the $1 will change, or the 5% will change? Like if I buy something today and it's worth 20 and I get this 5%, and then tomorrow the share price is 25, does my dividend yield change, or does my dollar dividend change?
No. So the companies typically companies will announce what their dividend is for the year and they won't touch it. So if
Okay,
you
they'll
bought
announce
this,
the dollar amount.
yeah. So in this example, if it's $1, it'll stay $1. It'll be $1.
Okay, got it.
You're
Yeah.
going to see in a couple of slides later that next year it'll probably be $1.03, $1.10. Dividends go up. So we're going to see that in a couple of slides, how the dividend is going to change. But as long as, in this case, as long as the dividend does not change, your return on investment is going to be 5%. So if the company keeps the dividend at $1 for the next 10 years, you will make 5% every year for the next 10 years. Right? Because your purchase price doesn't change. The day you bought it, that's the price.
So if I buy more stock tomorrow and the purchase price is different, then that dividend yield is different for me.
Will be
Yeah,
different.
got it.
Correct.
Yep.
Yes.
All right.
Good point. And so I do want to mention, so stock prices change every day. You log in to Yahoo Finance or Google Finance, you look up the share price, it changes every day. It goes up a couple of cents up and down. So every time the share price changes, the dividend yield is going to change. But the moment you buy the shares, that's it. That's your dividend yield.
This makes so much sense to me because I can see why. I was like, well, how do you do a chart to track if it's changing all the time? But now I'm like, of course, this is why it stays the same. That's why you can keep track of it.
So as an investor, just focus on this, right? How many shares do you own? What is the dividend per share? That's how much cash you're getting every year. That's it. So the share price can go up and down. It doesn't matter. I still have 250 shares and the company is still paying me $1 per share. I'm going to get $250 this year. So it's an annual dividend. It's every year. Yeah.
Awesome. Thank you.
Okay. So let me give you two real life examples, TC Energy and Walmart. The first example is a personal example of mine. I bought 185 shares in TC Energy back in 2000. And so my total investment in this company was $2,479. Okay, that was it. Today, that investment is worth almost $20,000. Okay, more importantly, the dividend yield that we just looked at The dividend yield based on my purchase price is now returning me 25% every single year. So 25% of my initial investment, which is $2,479, if somebody wants to take 25% of that, I don't know, $650, so like that, I receive $650 in cash every single year from TC Energy. That's a 25% return on my initial investment. I can't get that anywhere. What do you get in a savings account today? A checking account, or even a term deposit or a bond. A government bond is almost 1%. So that's a really good return. Here's another example. This one's not mine. Could be somebody's example, but it's a true example. So Walmart, in 1970, had you purchased 100 shares in Walmart at a cost of, total cost would be $1,650, 100 shares, and just held on to them, today they would be worth over $30 million. I checked the math this morning. It's correct. And if we have time, I will show you the math. If we have time, I can show it to you.
Wow.
Even more impressive, and I'm not, 30 million is impressive, but even more impressive than that, today you would be earning almost $500,000 every single year in dividends from Walmart. That is truly passive income. You don't have to work extra hard for that. You need to get a second job. You don't need to get a promotion. They will send you this money. And in fact, you don't have to wait a year. Most companies pay the dividend every quarter. So every 3 months, so you take that 450,000 divided by 3, you'll get that amount deposited into your trading account every quarter. So that is significant.
I can't wait to see the math. Okay, if we have time.
If we have time, I do have the slides at the end, but if we have time, you can certainly do that. The other thing that most people miss when it comes to investing, and I'm just going to put one slide on this, like in the course, we spend an hour on reducing your fees, but I'm just going to spend one slide on this. You need to look at how much you're paying in fees, and most people are not aware of that. So to earn more, you also want to reduce your fees. Here's a simple example of what it costs for you to invest $100,000 over 25 years. If you were to put that in mutual funds, you would end up spending $275,000 in fees over the 25 years. That's ridiculous. You only invested 100,000, but the company is taking away from you over 275,000 of that in fees. Index funds, also ridiculous. $142,000 in fees. Okay. ETFs, a little bit better, but not great. And again, these numbers are extremely conservative. I checked them again last night, and these numbers are assuming that you invest 100,000, and over the next 25 years, you don't put a penny into that investment. And most people don't do that, right? If you've got a 401k, an IRA, or a trading account, you invest every month, every year, regularly, right? In this screen, I'm assuming you're not doing any of that over 25 years. So if you were, which most people are, the fees are much higher. And if you're investing 200,000, 300, 500,000 over your lifetime, the fees are much higher. So it's just astronomical. Stocks, that's just based on a sample portfolio. If I was investing 100,000, I would put it into 10 stocks. So that's the cost of buying 10 stocks. A lot of the places now, like Charles Schwab, they have commission-free trades. So that would be zero. But that is a one-time fee compared to ETFs, index funds, and mutual funds. You are paying that every single year. They are deducting that from your account automatically. And that's the thing, it's a hidden fee. You don't really see it. It just gets deducted right off the top. And that's why most people are not aware of how much they're paying in fees over their lifetime. The average American over their lifetime will pay close to $500,000 in fees, which is crazy.
Wow.
Okay, very quickly, I just want to tell you how I got started. This is me back in 1999. I actually started, my first investment was mutual funds back in '89. I graduated in '96 from university, background in computer science. I got married in '97. But like I said, the first mutual fund was bought in 89. So I had 10 years worth of buying mutual funds. I had part-time jobs and throughout school. And I did that because I really didn't know where else, how to invest. And my parents told me to put money in mutual funds, and that's what they did. That's where their retirement savings were. And so I did that too. And around 99, I'm a numbers guy. I've got Excel spreadsheets for everything. I ran the numbers and I realized, looked at the last 10 years in mutual funds and index funds as well. I realized I'm not going to have enough money to retire with. Neither is my spouse. This is not going to work. And then in 99 was right before the tech bubble. I don't know if any of you are old enough to remember the tech bubble in 99 and 2000.
Oh, yeah.
It's kind of like what we're seeing today, where there was a lot of hype around today's cryptocurrency and electric vehicles, stocks, and everything is just going through the roof. Back in 99, it was high-tech companies. And you could buy a stock on a Monday for $30 and sell it for $45 on a Friday. And I'm not exaggerating. All of my coworkers were doing this. My friends were doing this. Everybody was doing this. And that's what they would do at work all day long. Have their computer screen open with the ticker symbol going by. And I had no idea. And I got sucked into this. And they said, well, you should buy this company. And it's going to really skyrocket and you can double your money. And you should really do this. And I bought my very first stock in this company here. A lot of you may or may not know who Nortel was. Nortel was one of the big giants back in 99. For those of you who don't know Nortel, it would be the same as investing in Enron or Blockbuster. And that's what I did. And this is a screen capture from back then. And you can see the stock price went from $120 to zero. Zero. The company went bankrupt. I lost everything. It wasn't a lot because it was 1999. I was fairly young. I think I only invested maybe $3,000 total. So the $3,000 was gone. But I learned a very valuable lesson then. And that was don't invest without knowledge. Right? If you're going to invest, if you don't know what you're doing and you start investing, that's not the right approach. So I decided that in order for me to become a successful investor, I had to learn from the best. Okay. I had to find some role models, not somebody who had rich parents or somebody who won the lottery, but individuals who were successful, self-made over the long term, 20, 30, 40, 50-year track record of success. So find out who these people were. Step 2, study their strategy, and then just copy what they did. And I'm going to share with you their strategies today. And so there's no secret sauce or anything, but I'm going to tell you what those strategies are. So for me, it was a 3-year process. So I started reading one book, led to another book, led to another book. I interviewed some value investors, not the ones on the screen. These are very popular individuals, hard to get in touch with, but local value investors, interviewing them and starting to learn how to invest properly. So 2 things stood out once during that 3-year period. All of the investors suggested, A, you should invest by yourself, and B, value investing. We'll get to that in a second. Investing by yourself. This is one thing that I believe you should not outsource to anyone else. You can outsource somebody to come clean your house, somebody cut the lawn for you, wash your car, that's fine. But when it comes to money, nobody cares more about your money than you do. So not your financial advisor, sorry, right? They get sales commission and they work for someone else. Not the person sitting behind the desk at the bank. You have to take responsibility for this. And it's so I tell people it's so easy that a 9-year-old could do it. And there's the proof. This is my daughter when she was 9. She bought her very first stock on that day. If you zoom into the screen, it says Royal Bank of Canada. So she bought 5 shares in Royal Bank of Canada. In fact, both of my kids started investing when they were 9. So my son is 18 now and my daughter is 14. And once a year we sit down together and we open up Excel and we enter all the dividends that they get in. And they're very excited about that. It's only $20, $30, $40, $100, but that's, to them, that's free money, right? Truly passive income. So all I'm getting at is it's not rocket science. And you'll see this. I've got a couple more slides to go and we'll see how simple this really is. The other thing, the role successful investors were talking about is value investing. I had no idea what that was, never heard of it until I started Googling it. Value investing is buying stocks when they are priced low, undervalued. Okay, this is really important. So the simply investing approach, basically the same thing, buying stocks when they're undervalued, and not just any stock, but stocks that are quality stocks and stocks that pay dividends. So if we put that into a nice sentence, that's what it looks like. The simply investing approach is buying quality, dividend-paying stocks when they're undervalued or priced low. So there's three key words here I want you to focus on: quality, dividend, and undervalued. So I'm going to talk about all three of them today. I'm going to start with undervalue first. So far, so good? Yeah, okay.
Good stuff.
Okay. Why do you want to buy a stock when it's priced low? You've heard of the term buy low and sell high. Because this is where you're going to be able to maximize your profits. And this stock prices go up and down all the time. So if you look at the example on the screen, there's no point in buying this stock at $51 or at 50 or at 60. The likelihood of it going even higher is extremely low because it's already at its historically high price. You want to be able to buy a stock at a much lower price. In this example, $14 or $12, right? That would be a better place to buy that. Now, how do you know when a stock is priced low? Right? There's thousands of stocks that trade on the stock market every day. How do you know when it's priced low and when it's undervalued? So I'm going to show you that right now on how to figure that out. So remember we looked at the dividend yield a couple of slides back. I'm going to stick with the same example. So in this example, the company is paying a dividend of $1 per share. The share price is $20, so the dividend yield is 5% if you bought the stock at this price. Now, let's say you didn't buy the shares and you waited a couple of days and the stock price dropped 18. Let's say you waited a couple of more days and they said, well, I'm going to wait here, and the stock price dropped to 16. Let's say you waited a week and the stock price really tanked to $10 a share. Does everybody see what's happening on the screen? What's happening to the dividend yield as my stock price continues to drop? The yield is going higher. Does everybody see that? Right? Now, in this example, is it better to, or would you rather earn 5% on your investment, or would you earn 10% on your investment? So you can show me 5 or you can show me 10. 10, absolutely. All things considered equal, you want to earn 10%. So another reason why you would want to buy a stock when it's priced low, because at its low price, you're going to be able to buy more shares. The dividend hasn't changed. You're just going to be able to buy more shares. And that's why you could make 10% versus 5%. Okay. I've kept the numbers simple, kept the math simple, but this is exactly how it works. So this is really important. As the share price starts dropping, the dividend yield goes up. And the reverse is true. As the share price starts to creep up again, the dividend yield is going to start going down. Okay. So let's look at this example here. Stock prices go up and down all the time. So what if I was to tell you that for this stock, the average 20-year dividend yield for this stock is 3%. Okay. Remember, every time the stock price changes, the dividend yield changes, but the average over 20 years for this company is 3%. So you go to Yahoo Finance or Google Finance and you look up the company name, and it says that the current dividend yield today is 5%. Okay. Remember, when the yield is high, the stock price is going to be low. So if the current dividend yield today is greater than its average 20-year yield, then the stock is undervalued. That's the buying area, right below the orange line. So any yield above 3% for this company means the company is undervalued. And that's where you want to buy anytime you're below the orange line. Okay. Now, what if I told you that, oh no, the current yield today for this stock is 1%? then you know that the stock is overvalued. It's priced high. So if you were looking at this stock, so it's really simple. Take the current yield and compare it to the average yield. If the current yield is higher than the average, you're good to go. The stock is undervalued. Otherwise, the stock is overvalued. And in this case, I would skip it. I would move on to another company. I'd say, you know, I don't, in 22 years, I have never bought a stock that was overvalued. So don't ever buy a stock that's overvalued. No matter how much you're in love with the stock, no matter how many friends will email you and tell you to invest in it, check this first. And if it's overvalued, you skip it. Move on to something else.
So powerful.
Yeah. And now if you already own the stock and it's overvalued, then you may consider, might be a good time to sell. Maybe. Now we have a whole section on when to sell. That's another hour-long discussion, but I'm happy to answer questions later about that too. Okay, this is very powerful. Like, take a screenshot of this. If you're on a Windows computer, you can do print screen. Take a screenshot and save it. And so anytime somebody suggests for you to buy a stock, you want to do this test first. In 22 years, I've never violated this rule. Quick example, there's 3 companies here. Which one is undervalued? Which one is overvalued? Let's take a look. If the current dividend yield is higher than its average dividend yield, then the stock is undervalued. Okay, and there's the answer. So Abbott Labs is overvalued. So I would skip it. I wouldn't bother researching it any further, right? And AT&T and IBM are undervalued. Okay, now I'm going to talk about just a couple of slides on dividends here. Here are the 3 common questions, misconceptions that I hear all the time, everywhere I go, and I talk about dividends. People will say that dividends are insignificant. So sure, if you look at this list, this is updated as of this morning, okay? You can see that the dividend is pretty low, right? You're not going to get rich off of 34 cents dividend or 36 cents. It seems insignificant. However, over time, dividends will increase. So back to my example of TC Energy, you can see that I bought 185 shares. Back in 2000, does everybody see what the dividend was? Can everybody see that? That's 80 cents a share. What's the dividend today? 348. The dividend has gone up every single year. So you can see the dividend yield based on the original purchase price right here is how I ended up with a 25.97% return annually just from dividends alone, regardless of the share price. So today it's at $67, but it can go down to 40 or 50, doesn't matter to me. As long as they keep paying the dividend, I'll keep making the 25%. Even better, my initial investment was $2,479, right? Look at how much I've made in dividends from this company alone today, as of today, total. So I invested $2,400 into this company and I've received over $7,000 in dividends. So do I care if the stock price drops to $40 tomorrow? Do I care if it drops to $20 tomorrow? Not really. The money has been made. So the dividends are your margin of safety, right? Here's the numbers for.
And then you still have all the potential gain if you ever needed to use that money to buy a house or something, you could sell it. And not only have you made the 7,300, if it's at 20,000, you've made that additional money.
Absolutely, yes. Or you could sell a portion of it. Yeah, for sure. Here's the example with Walmart, right? If anybody was curious about the numbers. So Walmart has had 47 years of consecutive dividend increases. The dividend at the beginning was very, very, very small. The other advantage Walmart has is they've had a 2-for-1 stock split. So in 1970, if you bought 100 shares and just held on to them, in 1971, those 100 shares, you'd now be sitting on 200 shares. You didn't have to invest any more money. You didn't have to sell any shares. Your shares were just now 200 shares. And then so on and so on. they've had 11 stock splits since then. So today you would be sitting on over 200,000 shares in Walmart. And so we take that and multiply it by the dividend today, which is $2.20. And that's how you would end up today, this year, with $450,000 in dividends deposited into your trading account.
So let's pause there for a second, because I think that a lot of times people don't understand what's happening. They think it's just in the increase of the stock price. That's all that most people are thinking about from a very beginner standpoint, right? In investing, they think the stock market has to go up and then that's the only way they make money. But what we're seeing here is there's actually two ways to make money. And
yes, absolutely. Yeah.
And
this is a much better way, because Lisa, I was just going to add to your comment. This is a much better way because it is also, our objective is creating a resilient portfolio, regardless of stock market conditions, that's going to generate passive income and growing passive income for you. So we don't focus on the stock price, we focus on growing passive income. Because if you're only focused on the stock price and a company doesn't pay a dividend, like Apple doesn't pay, no, Apple does, Tesla doesn't pay a dividend, Facebook doesn't pay a dividend, Twitter doesn't pay a dividend. So if there is no dividend, you're only hoping for the share price to go up. And hope is not going to cover your living expenses.
Right. It's so fascinating to me because nobody teaches this. Like, first of all, like I have an MBA, I have a CFP, and I have never seen it taught this way before. And it is so freaking simple. And I just want everyone, it's sad that there aren't very many people here, but I'm going to make sure everybody watches this who wants to actually expand their wealth and help their children, because that's also what I'm really thinking about here, is that people don't teach this, because if they teach it, if your financial advisor teaches you this, you don't need them anymore. That's why nobody teaches this. Like, it's so valuable that it doesn't get shared. And yet it's really silly because you're making it so simple. And yet I have never seen it done this simple before. Kanwal. Like, this is why I wanted to have this conversation. I'm so grateful to this conversation. Like, Jessica, I'm just going to tune in, and Jay, welcome. But Jessica, like, are you understanding what's happening? Because I'm
yeah, totally. Yeah, I feel like I want to go look up, like, what companies give dividends. Like, I gotta find my list.
Well, this is what Kanwal does, is he has a system, and I'm not sure what you share a little bit about.
We're gonna cover that, Lisa. It's coming up.
Awesome. Woohoo! Okay. Just want to make sure that our folks are understanding what's happening here. This is not, this is a big deal.
About the splits.
Yes.
So, like, that, is there any way of knowing that that's coming? Or, I mean, obviously Walmart does it pretty consistently, so you could look back and see if other companies are consistent like that. But why do they do the split, I guess, is the maybe.
Yeah, so the answer to the first part of the question, can you predict in advance when the split is coming? And the short answer is no, you can't. I've tried, it doesn't work, you can't. And even Walmart, they have not had a split since 1999, right? So that's 20 years have gone by now, and they've stopped now. And the other question was, why would a company split their stock? And historically, in the past, when a stock got above $100 a share or $150 a share, back in the old days before the internet, the companies felt that their stock was getting expensive, and so they wanted to lower the stock price. So when the stock does a split, the price gets cut in half that same day, right? So $100 share after the split is now worth $50, but you have two shares now, right? So your value, you haven't lost any money, but the shares are worth. So it was a way to drop the share price, right? Because the company was doing so well, profitable, dividends are coming in, and there's a demand for the shares, so the share price starts to creep up. If you look at Berkshire Hathaway, which is Warren Buffett's company, he has never had a stock split in its entire history. So a single Class A share, I haven't looked at it in the last couple of years. Last time I checked, it was $300,000 to buy one share. So that's what could happen. So they will split. J&J, Coca-Cola was the most recent split about 2 years ago. They did one. Yeah. Okay, I've got a couple more things I really want to share everything with you guys. So there's a couple more things I want to show you. So we already covered this. Dividends are absolutely significant because of dividend increases. So focus on that. The other question I get from people as well, dividends are not guaranteed. And you know what? That's absolutely true. Companies are under no legal obligation to pay you a dividend. So companies can reduce the dividend or they can eliminate it at any time, right? So as a dividend investor, how do you have any confidence? Like, what do I invest in? Am I going to make any money, or are they going to stop paying the dividend? What do I do? So for that, we look to the past. So here's a list of companies. You can see some of them have been paying dividends since the 1800s. And more important to me is this last column here. So take a look at Coca-Cola, 57 years of consecutive dividend increases. Think about how many recessions we've had in the last 57 years, how many market downturns we've had in the last 57 years. But companies like this continue to not only pay the dividend, but increase it every single year after year after year after year. So I don't know what's going to happen to my dividends next week, next month, next year. But when I look at a list like this, I can have a high degree of confidence that these types of companies will at least continue to pay me a dividend and increase it in the future. This is a very small list. I couldn't fit the whole list on the screen. There's about 75 US companies that have been consecutively increasing dividends for the last 25 years. So this is just a short list here. Okay, what happens to the dividend when the stock price drops? Everybody's focused on stock prices. That's what people seem to look at all the time. And like I told you before, stock prices go up and down every single day. So if you look at this graph for this company, American States Water Company, the last 13 years, you can see the blue purple line, that's the stock price. And the stock price goes up and down, up and down, up and down. There's places here where the stock price drops by $5, $10, $15, a $20 drop in the share price. You can see this. But what's happening to the dividend? That's the orange line. Has it ever gone down? No. In fact, this company has had 66 years of consecutive dividend increases. So then how can a company continue to pay shareholders when its stock price starts to drop? And the answer is because dividends are not paid from the stock price. The dividends are paid from earnings. And that's how much profit the company is making. Okay, same company, but I changed the orange line now. So the orange line doesn't represent dividends anymore. The orange line now is representing earnings. We call it EPS, earnings per share. So this is how much profit the company is making per share every single year for the last 13 years. So EPS will drop, comes up, drops a bit, comes up. But what we're looking for over the long term is we want to see an upward trend. So over the last 13 years, I think you'll agree that this orange line is on an upward trend, right? It's on a slight incline. That's very good. So as long as the company is profitable over the long term, they will continue to pay dividends to their shareholders. So we don't focus on share price. We focus on what's the earnings for the last 20 years for this company. Okay, those are the 3 misconceptions about dividends. I want to share with you very quickly 3 things why I think dividends are awesome. Number 1, it's an immediate return on your investment while you hold on to your shares, right? You're getting paid to be an owner of a company and just hold on to the shares. Without the dividend, there's no return on your investment until the day you sell. And then you're just hoping that the stock price is going to go up when you eventually will need the money, right? If you're going to retire in 10 years and there's a market crash in 10 years or a recession in 10 years that lasts for 3 years, now you're stuck. You can't sell. You're going to sell your stocks at a loss, right? If there's no dividends. But if there's dividends, you're getting paid while you hold on to your shares. It's cash in your pocket. And once given out, dividends cannot be taken back. And that last line is important because over your lifetime, investing lifetime, you will have one or two companies, no matter how much homework you do, that they're going to go bankrupt. But the advantage here is the dividends that you've collected over the years are yours to keep. So in my case, I invested in TC Energy, $2,400 in the company. I've received over $7,000 back in dividends. So the company could go bankrupt tomorrow, and I will have lost nothing, right? So it's your margin of safety. Every time you get a dividend, your sort of risk comes down. Every time there's a dividend increase, your risk comes down. And every time there's another increase, risk comes down. You get another dividend payment, risk goes down. And so that's what you want, is to be in a position where your risk is low. Okay, last section here. Are we doing okay on time, Lisa? You'll let me know.
Yeah. We've got about 10 minutes, essentially. So what's the best?
Okay.
Whatever's the best.
Okay, I'll just, yeah, this will be really quick here. So the last thing was quality. How do you know you're looking at a quality stock? Okay, to help you with that, I've created what I call the 12 rules of simply investing. Okay, I cover them in the online course. It takes about 2.5 hours. We use real life examples. There's a spreadsheet. We fill it out. You can apply the 12 rules to any stock anywhere in the world. Like Lisa said, we have 10 minutes left. We don't have 2.5 hours, but I do want to show you the 12 rules. Okay, so this is what it looks like. They're available on my website anytime, simplyinvesting.com/rules. Okay. Now the way it works, and I'll spend 2 minutes just going through the rules here. The way it works is if a company fails even one rule, we move on. So if you fail any one of these, move on to something else. Okay. I know it sounds strict, but it's going to save you a lot of money in the future. We're trying to minimize your risk. Do you understand the product or service offered by the company? You don't need to be an expert in how the company is making money, but you got to be able to explain it to a 12-year-old, right? And if you can't do that, move on to a different company. Will people still be using the product or service in 20 years? If not, move on to something else. Does the company have a low-cost competitive advantage? So 2 perfect examples would be McDonald's and Coca-Cola. Coca-Cola is in over 190 countries. The company is over 115 years old. You could take that Coca-Cola logo anywhere in the world, show it to somebody, and they'll immediately know what you're talking about. They have a competitive advantage. If you were to start a software company today to compete with Coca-Cola, you would have to spend billions and billions in advertising, and you still wouldn't get to where they are today. If you want to drink a Coke, there's only one company in the world that can give it to you. I know there's generic brands, but if that's what you want, if somebody wants a Big Mac, there's only one company that can give you a Big Mac, and that's McDonald's. And people will cross the street to go to McDonald's, even though there's closer burger joints right next to them to get that. So they have that competitive advantage. Is the company recession proof? So let me ask this to the group. If there's a chance you may lose your job, right? We're in the middle of a recession. Let's say we are, right? And there's a chance you may lose your job. Are you going to go out and buy a new car? I'm looking for a reaction. You go yes or no?
Nope. Nope.
Absolutely not. That's why we don't invest in car companies. General Motors was the first to cut the dividend last March during COVID. They cut it to 0. Okay. Same question. If there's a chance you may lose your job, are you going to go out on a vacation, expensive vacation overseas with your family? No.
Nope.
And that's why we don't invest in airlines or in travel companies. Another example, Boeing was the first aircraft manufacturer to cut the dividend to 0 last March. Okay. Now, if there's a chance you may lose your job, you still have to eat. So you're still going to buy groceries. And at the end of the day, when you come home at night, you still have to turn the lights on. So those are the kind of companies we want to invest in. They're recession proof. So even if there is a market crash, these companies will continue to pay you a dividend, right? Rule number 5, consistent earnings growth. So it must be at least 8% or more. This is self-explanatory. The graph on the left is good. One on the right is bad. So if you, and you can look these up for any company, right? So if you see that their 20-year average for the earnings is horrible and it's a downward trend, stay away, right? There's
Here's your
companies today that
Tesla.
have, that's right. There's companies that have a negative EPS, which is they're losing money. And there's people on the internet saying you should invest in them, right? So it's common sense. We want to look at that. Rule number 6, consistent dividend growth. This is important because this is your passive income. So we want to see over the last 20 years, at least 8% growth in the dividend. Again, self-explanatory, right? So that's the 20-year. This is actual graphs for actual companies, right? So you can see that. Rule number 7, low payout ratio. Let's just look at the left side first. Let's say the company is earning $2 a share. Okay, last year they earned $2 per share. And then they paid a dividend of $1 per share to the shareholders. So that's pretty good. That's a payout ratio of 50%. What do they do with the rest of the money? They reinvested it back into the company to grow the business. So that's really good. If we look on the right side, this company also earned $2 a share last year, but they paid $3 a share to the as a dividend to the shareholders. What's wrong with that picture? Right? The payout ratio is over 100%. So the company is borrowing money from somewhere to pay the shareholders, and that's not sustainable. So they're going to have to reduce the dividend or cut it altogether. So we want to stay away from companies that have a payout ratio of more than 75%. Okay. Rule number 8, we look at companies with low debt. Rule number 9, companies should have a good credit rating. Rule number 10, companies should be actively over the long term buying back shares. And so the first 10 rules have everything to do with quality. If a company passes the first 10 rules, you know that you've got a quality company on your hands. Rule number 11 is focused on value. So 11A, the P ratio must be 25 or below. 11B, we already talked about. Current dividend yield must be higher than the average yield. So then you know the stock is undervalued. And then we also look at the price to book ratio, 3 or less. The last rule has nothing to do with any numbers, but everything to do with you. You have to keep your emotions out of investing. And I know it's hard, especially when it comes to money. It's not easy to get emotionally attached to companies or to stocks. But the key here is discipline and patience. So you have to have the patience to ride out any market crashes or recessions, if and when they happen. I shouldn't say if, when they happen. So the stock market goes in cycles. So we know there's going to be crashes in the future. But you want to have a resilient portfolio and you want to have the patience to ride it out and the discipline to stick to the strategy, right? We're long-term investors. So any money that you need in 5 years or less, if you're saving for a down payment for a house or for a car or for a family vacation, for sending a child to school, education, any money you need in 5 years or less should not go into the stock market. So that includes mutual funds, index funds, and ETFs. Right. Okay, so those are the 12 rules. And that was a quick summary snapshot of everything.
That is so good. That's so good. Jessica said, what do you do with your dividends? Do you often reinvest them?
Yes.
Mm-hmm.
Were you asking Jessica or were you asking me?
No, Jessica had a question. Sorry. That question of reinvesting. Are you often reinvesting the dividends back in the stock?
Yes.
Are you using the same procedure? I guess
absolutely. Yes. So what I personally do and what I teach is I have a portfolio of stocks. They all pay dividends, and they all pay dividends at different times throughout the year, which is fantastic because every month I get paid. Every week I get paid. There's money deposited into the trading account every week. What I do is I allow the dividends to collect in the account, and once or twice a year, I will take that money and then I'll apply the 12 rules of simply investing at that time and find a company that passes all the 12 rules and then take those dividends and invest in another company. So I reinvest the dividends. And that is huge because now it's a snowball effect. Because now I'm investing in stocks. I'm not putting any new money into it, because I got those dividends for free. They're passive income. They're just, the cash is just sitting there, and I'm putting it into stocks which are going to give me more dividends. And then that
Awesome.
just compounds every year,
Yeah,
right? And
so good.
so that's how you
So
grow.
good.
Yeah.
Do you have a slide? I know you were working on launching a new offering. Do you have a slide about that, or what's the next place that people would go to? They can come to the website and get signed up on your website, but you also have a service, right, that you are getting ready to launch. Has that launched?
Can you see it on the screen?
I can see. Yeah.
There's a table on the screen. It's a website,
Yep.
Simply Investing
Yep.
Platform. Okay, you
Yes.
are the first people on the planet to ever see this. This is going to launch next month. It's not ready yet. It's 99% ready. It'll be going out next month. So what we do here, I built this. It took 2 years to build. We take the 12 rules of Simply Investing and we apply them to over 8,000 stocks every single day. And so this narrows down all of the work. So for example, if we were to look at US stocks here, there's about 5,000 stocks in the US today. There's only 41 that pass all of the 12 rules of Simply Investing. And the rules are all here. So you can see rule 5A, 5B, even tells you what the rule is, what you need to pass, but they all pass.
And we have another call starting in 2 minutes, but so one question I have for you is maybe you could send me, well, any which way, make sure and let me know when it does come live. But even in the meantime, whatever you want me to share with everyone in the group as we send out, notification of this replay, happy to do that too.